which is good. Wait till so I'll sort the lobby out as usual, and then I'll look at the chat as well. And it's now 10:30. We'll start bringing people in. Give it a couple of minutes, and then we'll be away. So let me admit all. There we go. Good morning, Henry. Good morning, Con. Good morning, Paul. Good morning, Lincoln. Good morning, John. We'll continue to admit people. If you've just joined, if you could go on mute, that would be great, please. Henry, that includes you. Morning, Graham. Morning, Gareth. Morning, Kim. Morning, Steve. Morning, Paul. If you have just joined, if you could go on mute, that would be excellent. Thank you, Graham. Morning, Catherine. Some more people coming in. Professor Bromwich. Good morning, Professor. Good morning, Andre. Good morning, Barry. If you have just joined, if you could go on mute, please, just to cut out any sort of background noise. That would be great. Thank you very much. And there's a few other people joining as well. Let's just make sure. Yep. Okay. Oh, and more people in the lobby. Nearly there, Anthony. Hang on. We'll get to you in a minute.
I'd assumed everyone was still on holiday, but clearly they're not.
Well, I know. They've all come out of their tents and their caravans just for this event, which I think is remarkable. So, it's excellent. But that's commitment to market, you see. Commitment to market. If you could go on mute, Bob. Bob, I'm going to mute you if that's all right.
Okay.
Background noise. There's a few others. Oh, more people coming in. Wow, you see, that's amazing. Good stuff. Okay, it's now 10:32, Anthony. There'll be a few more people joining. I'll monitor the mutes as well, if I may. Just if you've just joined, if you could mute, that would be great. Just to cut out any background noise, that'd be good. And somebody's got kids.
It's usually me. Usually me.
I was going to say, hang on. Oh, thank you for that. Whoever that was, muted. Thank you very much. Okay, right. Let's start. Good morning, everybody. Welcome to the coffee morning this week for Pension Playpen. For those of you that don't know, I'm Steve Goddard, CEO of Pension Playpen, and we are delighted today to be joined by Antony Barker, who is MD of Disruptive Capital. And really thank you in advance, Antony, for your time this morning. And it's a presentation about stagflation and time travel, which I'm really interested in. I'm a great fan of Back to the Future and Sliding Doors and all those famous films. So this could be Back to the Future, and we really look forward to it. Before we start, don't forget, if you would like to ask a question, please raise a hand. We'll open up the chat room as well. And we will take questions as and when. This is very informal as usual, so please don't be afraid to ask a question. And this is being recorded, so Graham, Henry, Andre, Padraig, everybody's happy to be recorded. If you thumbs up, yep, good, okay. Antony, over to you, if I may. Thank you very much.
Thank you, Steve, and thank you everyone for attending. Okay, so this is very much sort of my rambling thoughts I've had over the weekend as I've tried to sort of look at, as everyone goes back to work next month, are we really in some sort of a new paradigm? And I'd sort of start with a bit of scene setting here. I mean, think of, a world where, inflation measured, say, by RPI is running, well into double digits, maybe 11 plus or more. We've got an energy crisis, but a government that seems to be reluctant to discouraging investment in sort of new indigenous reliable energies, but instead is just sort of throwing around ideas of a populist windfall tax. The Bank of England has started to raise interest rates, but real interest rates are still very, very negative to a huge degree. And, so anyone with cash deposits is making huge post-inflation losses. And this is coming on the back of, potentially an enormous expansion in the money supply. The fact that we have a government that can print its own cash has allowed for prolific handouts. And we've seen, worldwide a period of globalization and, maybe financial stability, though, that's led to a record bull market in sort of long duration assets, such as equities, long dated gilts. However, maybe there's a sort of hint of investor concern. Stock markets have begun to turn down, and commodity prices suddenly only seem to be going in one direction, impervious to the demands of consumers. Now, this is really not, the sort of horror movie of the 70s, but it's the investing reality of today. We are back now where we were at the beginning of the 1970s in many respects. And it's very easy to sort of throw blame about, but and quite often we blame the insurance, the energy companies, but the only thing we can really blame them for is the first private sector pension scheme. So hang on, I'm having a little bit of trouble here with the slides. Here we go. And going back to the Gaslight and Coke Company founded this scheme back in sort of 1841. So there's nothing new in pensions. I don't think many of us were around then, but despite what my wife often accuses me of. But we could easily blame not just the energy companies. There seems to be a lot of blame flying around for the banks, the media. But again, the only thing we can probably blame them for is the very early pension funds. So Reuters there set up in 1882, Lloyd's followed in 1929, and lots more schemes followed on afterwards. And that led to a huge expansion in pension funds. I seem to be getting a deluge of invites every day to conferences coming up in the autumn. But we're a long way off the sort of peak participation of pension schemes in the mid-50s. 37,000 schemes, 1 in 3 workers were in occupational pension schemes, and ever-growing popularity in the 1970s. So great history of pension schemes, a less great history, though, of the companies behind them. And, going back to 1935, we saw the launch of the Financial News 30 share index. Great pub quiz question in that one, because people will say, well, surely it was the FT 30. Actually, Financial News was taken over by the FT subsequently. But when we look back at those 30 shares, the original industrial and commercial entities, only Tate and Lyle and what we would now know as GKN, still exist as corporate entities today. That's a pretty high failure rate, and it's carried on. Going back to 1985, a third of FTSE 100 companies, supposedly our big multinationals, our strongest companies, have all failed or run into serious financial difficulties impacting their pension fund. Now, sort of 2005 saw the launch of the Pension Protection Fund, and on average, we've seen 50 to 100 schemes enter the PPF, the lifeboat fund, every year, which has been great because it's given people some sort of benefit underpin which they didn't have before. What's quite interesting, though, in the last 2 years, there's only been about 10 to 15 companies entering into assessment. So somehow, they're being kept suspended. Maybe it's down to furlough, maybe it's because of cheap money, or maybe it's just been a head in the sand attitude where people were sort of ignoring the reality of corporate circumstances. But I've got a horrible feeling that that's all going to change. That clearly pressures are coming through, and I don't think many people could be living the lie much longer. Well, we all know what our industry looks like, that we've seen a declining number of schemes, just over 5,000 today. And whilst, assets have done relatively well in recent years, by and large, they've fallen short of buyout funding. So the options for companies to offload the pension obligation seem to be driven largely as a price consideration. There are a lot of other reasons as well, which I'll come on to in a minute, but that was the big driver of what was going on before. So what's changed since this sort of period of history, which was probably the sort of the dream time for pension funds? Well, we all know the story. Yeah, yields came down progressively over the last couple of decades, and that just drove up the cost of liabilities. But it was also being done now against a background of rising inflation. And as we have to remember, going back to those first founders of pension schemes, most DB sponsors are not growth companies. They're not the Amazons, the Googles, the tech companies that we have today. And so they're not seeing their incomes go up in the same sort of demand-driven way. So perhaps we are back again to the 70s. The last time we've seen this huge disconnect between base rates and inflation is that sort of period of time, long before perhaps many of our corporate advisors were born, let alone, conceived or studying. This is a very unfamiliar piece of history, and one that isn't necessarily modelled into most people's asset and liability scenarios. Just before we all joined, Steve was making the point, well, is this just a temporary blip? And I think the answer is, I don't know. And I don't think anybody knows, that by and large, central banks have been appalling at forecasting inflation. The Bank of England, stuffed full of PhDs and masters, doctorates, economists, seems to have, got their inflation forecast wrong quarter after quarter for decades. I'm not sure why it gets any credibility. Indeed, the only people who are actually worse at forecasting inflation, and they've got even more PhDs, is the Fed. So, quite clearly, we could be in this position for a lot longer. But it's been very easy for politicians and others to simply dismiss it. Oh, well, it's down to the war in Ukraine. It's down to, high energy prices. Undoubtedly, that's a problem. But if you strip those out, it's very clear that something nasty is happening. The underlying inflation is running very high. And, this is the things that people are spending money on. And, well, I've stripped out alcohol as well. And I think that's about the only thing that's has a greater dependency than cheap interest rates. And we need to sort of get back to the root cause of what's causing this, how long is it going to persist, and what can we do about it? So to understand that, you sort of need to sort of think, well, where have we been? Now, there was certainly a belief as we came out of COVID that we were having this positive demand shock. People were going out, they were buying, and everyone was in a generally positive frame of mind. This was a slight sort of overbearing of the previous fears that actually, we'd come off the back of the credit crisis. We'd seen sort of recession in the early sort of 2010s, and the government had stepped up to manage it with a period of cheap money that had led to the boom. We're also, we're definitely not in a Goldilocks scenario, though, often talked about, but we've seen a lot of these eras over the lifetime of pension funds as new technology has come on board. The real question is, though, are we in stagflation? And traditionally, that requires a negative supply shock. And a lot of commentators back end of last year, beginning of this, was saying, well, they couldn't see it. And even though there was an oil price movement, it wasn't necessarily one that was going to drive us to a stagflationary environment. Yet inflation is ticking up. So the question is unemployment increasing or employment coming down? Now, we're not necessarily seeing huge increases in unemployment, but I think we are starting to see huge reductions in employment. And this is the so-called quiet quitters, that actually this move to possibly home working, removal of presenteeism, maybe a generation coming through that says, look, it doesn't really matter how hard I work, I'm never going to be able to afford that house, that car, you know, I should be focusing on my lifestyle today. You know, whether you want to call it a woke behavior or some sort of millennial attribute, the reality is there's a lot of people thinking like that. And yes, they're employed, but they're clocking off at 5:30 to walk the dog. They've improved their lifestyle, which is great for reducing stress and increasing longevity. And I'll come on to that in a minute. But it definitely means that net, we are reducing our employment capacity. We're reducing productivity, and taken together with a high inflation environment, stagflation may be occurring faster and sooner than we think. As well as sort of seeing this quiet quitting impact, we do have the sort of overall issue that impacts pension funds in particularly, is what longevity does for the productive workforce. And the reality is not that so much we are sort of living too long, but we're retiring too soon. And, you know, you contrast the history of where life expectancy was when the first UK state pension scheme was introduced. And, you know, the state pension age was 70 then, and you were best only expected to live 9 years. But for the vast majority of the population, they never got there. Today, most people do expect to get to state retirement age. It's been brought down, and, you know, there's a very, very high life expectancy. You know, I have got I think she's carrying a 9-year-old daughter. When she was born, her cohort of the first year expected to live to 100, you know, and, you know, that wasn't forecast when sort of the state pension scheme was put around, less so privatised pension schemes. So forget that Labour's not working, longevity's not working for us either as well. And take these two together, again, we seem to have all the movements towards some sort of disconnect. So I think the last point that I want to leave in terms of the sort of history is very much, you know, we are being driven by a regulator to focus more and more on governance, but governance is not necessarily the same as management. And the cost impositions on pension funds seem to be also been going up in a very inflationary manner. And, you know, to do things properly to the level required, and that's what we should aspire to, is getting more and more expensive. The question is, are we getting value for money out of that? But perhaps even the biggest issue we have is trust in the system. And, you know, for those sort of Latin advocates, the credit crisis was not necessarily a crisis of cash flow, but a crisis of credare, or credit trust, you know, and we lost trust in the financial system. The problem is, are we losing trust in the pension system? And, you know, a couple of weeks ago, the Playpen focused on the British Steel issues, but it is simply the latest in a long line of big, expensive issues tying back to pension schemes, participation, underpayments, maladministration, and not necessarily fraud, just in many cases incompetence. And unfortunately, a lot of these also seem to be driven by sort of government activity. So the question is, what are we going to do now about it? And this is what hopefully is going to stimulate a bit of a debate. Well, clearly longevity still remains a huge known unknown, to be rather Rumsfeldian about it. That, you know, we don't really know yet what the impact of COVID is going to be. Is it going to create a range of superhumans, you know, have all the nice positive habits about washing our hands and things helped us sort of generally encourage longevity, or has it just highlighted our susceptibility to disease? And, you know, the next virus comes along as it continues to mutate. You know, we're in a long-term battle with viruses. Against that, therefore, you know, hedging longevity seems to be a really good idea. And, you know, traditionally pension schemes have passed this off to insurance companies who also look to reinsure it. And the insurance market has certainly seen some huge peaks in it since it got going. It's not as new as most people think. It's only really been, bulk annuities have only really been going for probably about 10, 15 years in the way that we know them now, and certainly saw some spikes in 2018, 2019. Where to now? Well, the market appears to be bifurcating. We've seen a lot more competition come in as Standard Life and others have returned to the market. But the trouble for many schemes are those caught in the middle. The insurance companies also only have finite resources, and that will either want to focus on the big transactions. There's a lot of competition for the circa £1 billion schemes. Likewise, they can cookie cutter the smaller schemes and sort of overcharge for all of them, and that helps sort of allow them to get around some of the sort of smoothing that they've done in terms of their pricing. The problem is that the average pension scheme in this country is more in the sort of 100 to 500 million pound size, and those are the ones that need a solution. Too big to be cookie cuttered, but actually require the same amount of work as a 1 billion, 2 billion pound scheme to price accurately, yet obviously by definition offering lower returns. We've sort of highlighted the fact that the Pension Scheme Act is going to push sponsors to try and sort of get away from pension obligations sooner to avoid criminality. But before that, there may be a huge number of event-driven sponsor insolvencies forcing schemes towards the Pension Protection Fund and lower returns. And is now a good time to do it? Well, in theory, it is. If certainly in the last sort of 5-6 years, we've seen a market where if in the right investment strategy, in theory, you should have certainly the surplus to get yourself over self-sufficiency. Possibly you've now got enough money to buy in your liabilities. The problem for many schemes, though, is they locked into high hedge ratios when at near zero yields and are busy fire selling everything they can to meet their collateral calls, having sort of not bailed out earlier this year as yields rose, and are now facing quite a regret risk. Loss aversion is huge. There's plenty of studies on behavioural finance, and it's a very challenging discussion for trustees to have with their CFO, who managed to find 100 million of contributions last year, only to be told they've had to crystallise a 200 million loss. So although the theory is great, the question is, are we going to practice it? And there are lots of reasons why people are saying, well, they can't do a deal today. Why they still have active accrual. The insurance market isn't covering deferreds as much as they like, but I mean that seems to be improving because of either reinsurance or maybe some sort of flexibilities in Solvency UK or whatever it's going to be called, that's going to sort of mitigate much of the Solvency II matching assets. Problems with sign-off of data, problems with GMPs, problems with governance. A whole host of reasons why not. But possibly one of the bigger ones is conflicts of interest, and the fact that we've just not got pension schemes ready. I think somebody posted something yesterday very much saying that the biggest bar to doing transactions was data quality, and to that end, I'd sort of throw this one up is to what even predates pension funds is in fact the first electric car. And whilst we think this is all a creation of Elon Musk in the last decade, the reality is that the first electric cars were around in the 1820s, 1830s. But what changed the car industry in the same way as what's going to change the pensions industry was not the concept of the car. I mean, this was just simply a horse or oxless vehicle. It was battery technology, and more importantly, the rechargeable battery. And I would argue that the battery of the pensions industry is data. I remember when I first started, valuations and computing power was not what it was. There was a lot of card files, a lot of paper records, but 40 years on, are we really not getting to electrification of our data? Are we not really able to operate in real time and continually enhance data quality and therefore drive better decision making? It seems slightly ironic that we may get an investment model from a consultant with 10 basis points difference between 12 different types of credit instrument in terms of setting asset allocation, when we don't know where 20% of our pensioners live, and we don't know whether 10% of our deferreds are even alive. That unless we fix the battery of the pension scheme, we're probably not going to change where we are. So does that mean we should do nothing? Well, there's a lot of talk of alternatives and to buy out, not just super funds. And, we're increasingly seeing the idea of alternative covenant schemes. And this is a way of where you could sort of hedge today's price while you fix all the aspects of your transactions. This is where external capital comes in to support the sponsor, that it creates a funding buffer that the pension scheme has a first charge over. So not just an asset-backed contribution arrangement, this is new capital. And that allows trustees to invest their way in a controlled way over the next 7 to 10 years to some exit price, be that a super fund, be that insurance. But it does give people a way forward and basically saying, look, I get we've got issues why I can't go to an insurance company today for all the reasons I've highlighted, but should I really forego locking things out when actually the next year, 2 years could turn into a nightmare scenario? So really, to try and draw this to close and so we can have a bit of a discussion, we quite clearly are facing up to some pretty difficult times. This needs, therefore, some difficult decisions to be made. And, complexity is always there. Pensions are difficult. We know that. We've spent almost 1,000 years evolving the current pension system, and whether it's been fit for purpose has been a perennial challenge. That we've had a financial crisis, we've had a COVID crisis, and we're now faced with a weak economy that is struggling to generate income for people, not only to pay the pensions that people expected, but to pay the salaries that people need for the basic minima. We now have an industry in transition. We have to admit that the pension scheme industry is in runoff. It needs to consolidate in some form to remain economically viable. That's happened to every industry before, and at the moment, we do seem to be a little like, everybody's driving around in Morgans and spending a fortune on servicing rather than basically upgrading and fixing and getting something that is functional and works and is suitable for today. It may look great, but if it doesn't work, it doesn't work. And, if we have a long-term problem, well, maybe we need long-term assets to solve it. But the outlook doesn't look great. If you look at what investment returns were in the 1970s, then actually gold was great. It outperformed, equities, bonds. People gave up on currencies. Traditionally they dumped the dollar when people realized that the US couldn't actually afford its obligations. And if people dump the dollar, normally currency parity means that they start dumping sterling. That then just makes it even harder for an island nation, depending on imports, to actually acquire. We have more inflation in the system. This could go on for longer. And as I said, we have real problems with, trust within the industry, and therefore, if people don't believe what they're being told, they're not going to act on it. And yet, I think there is a lot of good reason to say that, in fact, theoretically, pricing looks great today. And, as an industry, we need to do something about fixing it rather than moving forward. Now, I close on an analogy, although this is a namesake, I can't claim to be it. This is actually Joel Arthur Barker. And he said, very simple, vision without action is merely a dream. And, I know a lot of trustees will be looking at some fantastic dashboards, reports and everything. But if you don't do anything with them, then, they're hopeless. Likewise, unless we know what we're trying to fix as an industry, and maybe it is the ultimate runoff, then, this is a lovely conversation, but it's not actually achieving anything. So I think we have to gird our loins and basically just do something. So thank you, Steve. And I see there's an awful lot of comments have been sort of coming through.
Thank you so much, Antony.
I throw the floor open.
Yeah, that's a fantastic snapshot of the past and the current, and what do we do about the future, I guess. But I've got quite a few comments in the chat room. Con, do you want to just make your point regarding the Swedes' success with pandemic support? What? Oh, blimey! Con. Yep.
Can you hear me?
We can. It's a little bit fuzzy, but yeah.
Sorry, I'm actually in an airport waiting lounge en route on holiday.
Nice. Very nice.
The point I was actually just making there is that the support mechanisms that were put in place at the beginning of pandemic resulted in lower levels of company failure. The most stark example of that is actually the Swedes. Their pre-pension guarantee, which is their equivalent of the PPF, saw no failures at all in 2020 and just one in 2021, which means they actually did rather better than we did in relative terms. I think the most important thing that's on the horizon currently is what gets said and what gets decided, or the decision makers influenced in Jackson Hole. Was having difficulty remembering where the Tetons were there for a second. That I think is going to really determine whether or not we chase inflation, much of which we can do very little about. At least there's not much that we can do about the price of oil and natural gas, at least not in Europe. On the other hand, there are some signs that some of the effects of the Ukraine war have in fact already been dissipated. Food prices and grain prices have been coming down for the last 6 weeks or so. But the major problem right now is inflation.
Indeed,
that's all I
Con.
wanted to say.
Cheers, Con. And actually, I mean, number one, Antony, do you want to respond on that? Number two, I'll come to Andre because Andre's made an interesting link with that, but we'll come back to that. So, do you want to respond, Antony, first of all, to Con?
I mean, Con's points are well made. I mean, the interesting sort of lack of analogy we have with the sort of investing and decision making in the 1970s is that we didn't have index-linked gilts. They didn't come along till the 80s, and I think they peaked in 1991 with positive real yields of around 4%. And had we sort of bought them all then, we could have shut down the industry and all gone home 30 years ago. Instead, we didn't, and we are where we are today. I certainly agree. I mean, it's inflation is the issue here, and we can look back and say, we understand what's caused it, but the trouble is how do you solve that? And with governments and their ability to provide financial subsistence to the banks, ultimately into the consumers, to employees. It's all the time you can print your own money. It's very easy to put off the painful. And I think that's what happens when you're in a populist environment and you're trying to run populist policies. And I think that's clearly been very evident with the competition between the two candidates to be Prime Minister.
I'm in the middle of a webinar, which will finish about half an hour.
Hang on. I don't know who that is. Let me mute that.
Okay.
Hang on.
All right. Cheers, Steve.
Yeah. Cheers, Steve.
So yeah, I mean, the question is, that there is pain that has to be taken to correct inflation. The question is who's going to take it and how are we going to take it, and can we sugarcoat the pill in any way?
Yeah. Okay. And that links nicely to Andre. Andre, do you want to just quickly ask your question, because some of this is referring back, this is time travel back to the 70s, and what's your comment, Andre? And yeah, go for that.
Thanks, Steve. It was just just an ignorant question, I guess. So we had the 70s and everything was terrible, and then we moved into the 80s and 90s and things were better. And my question is just, was it a problem that was proactively solved, or did the world just change and things just started moving in the right direction again? Because inflation obviously went down again, and so what happened? Was it proactive governments, or was it just factors outside of people's control? So the question kind of is trying to understand, is there anything we can do now, having learned the lessons of 50 years ago?
I suspect one of the biggest shifts was technology, and globalization. So we had the abolition of currency controls. So we saw greater globalization, and if you look over the last 30, 40 years, the biggest downward pressures on inflation have been a combination of technology and inflation, technology and globalization. Technology continues to improve apace. The question is whether it is enabling productivity or replacing productivity. Globalization is probably a more interesting question, because you could argue that Brexit and its equivalent that is being mooted in a lot of countries is anti-globalization, and therefore the theory ought to hold that if globalization reduced inflation, nationalization, or whatever you want to call it, is inflationary. And that could be one of the one of the issues we have to face up to, that if we want to be supposedly more in control of our own sunny uplands, it comes at a price.
And so there's what I think Andre's saying is there's no lessons learned in the 70s where we can just replicate that and get out of it now. That's really, I suppose, the question, Andre, isn't it? So yeah. Okay. Sack, you made a point regarding the younger generations, the future generations, and then we'll come to John. So Sack, you just want to make your point about
Yeah, I mean, just basically looking at how DC pots are behaving, and how the younger generations are opting out of pensions because their pots aren't performing, and they're getting results of they won't be able to afford the Morgan, let's say, if we like. But I think generally what we're looking at is how the future generations see the DB environment, and how what strain that will put on governments, obviously, where people won't be able to afford the cost of living in the future. I mean, I say that because, from a personal perspective, I've been granted protected early retirement. Based on that, looking at the figures, that's going to be a total impossibility for survival. But just looking generally at how annuity rates are performing, where members are being offered drawdowns, the whole system, the mechanics behind pensions now, for fixing that. That's really what we as pension professionals should be looking at more so than, and let the sort of the investors and the investment professionals look at, and governments look at how overall finances are going to perform for future generations. And I think really that's important really, and how we can fix the whole scenario. Let's look at an example of what pensions at early retirement are offering. So for £1 of pension at early retirement, you're looking at around about £25 to £27 as a cost. And at normal retirement, that annuity rate, depending on whether it's linked to increases at 3% or whether there's a spouse's pension attached to it, that could fall at normal retirement to £16 for £1 of pension. So it's the mechanics of the pension scheme really, that and the DC environment, having phased out and phasing out final salary arrangements, how that mechanic works. So it's just a little bit to throw something into what's currently happening in the pensions environment as a result. Thank you.
Yeah, I appreciate that, Zach. And next week we have annuities is the hot topic. So actually, that will be part and parcel of that. But Antony, any view on that? I mean, do you think there's disillusionment in the younger generations and it's not really their problem, or some of the younger generations will be active members of some of these final salary schemes, which may be another 50, 70 years off into the future? What's your thoughts, Antony, on that?
I mean, it's a long-running debate about intergenerational fairness that sort of peaks in every sort of radio and TV phone-in. But I certainly know, my own children sort of, express concerns as to whether, they'll be able to afford, houses and cars and things. However, what they're equally possibly ignorant of is how a generation that now has access to their pension pots early are possibly having to spend them to, make ends meet over the next 2 to 3 years, and is therefore storing up a problem for, a decade or 2 decades ahead. And, what is usually the issue that is misunderstood about longevity is not that, we've created a race of superhumans and, suddenly everybody's living to well into sort of 200, is the fact that suddenly everybody is living till 85, 90, 95, 99. And so collectively, our demands are increasing. So, there is definitely an individual problem. There is also a practical problem. And, those people in receipt of pension who, certainly have a fixed income at the moment, maybe sort of worried about sort of having to fund care and all the additional end of life issues that they're worried about, are suddenly being told, well, yeah, the underlying cost of what you spend on is going up 10, 15%, but your pension is only going up 3, 4, 5% at best. So there is a lot of people going to be suffering across all generations, and DC schemes, properly designed, but more importantly, properly funded, can offer great flexibility and great opportunity. The problem is that we have collectively failed to recognise just how expensive pensions are, as was highlighted in some of the statistics just came up earlier. But also that people need to put money into them if they want a big pot at the end. And so we've got consumption instead.
Yeah, okay. John Mather, you've made a comment in the chat. Do you want to say your comment? And then we'll come to Professor Michael Bromwich, because there was a big attack on professors earlier on, Antony, so I want Michael to defend himself. John, do you want to sort of raise your point?
Well, I was just looking at who are the beneficiaries of inflation, and it's normally those with debt. And since the government seems to monopolise that area, I think they're going to enjoy a debt reduction like never before, at the expense of the population. And until productivity goes up, basically you're screwed. So you've got more debt than you had at the end of the Second World War. Where's that going to go? Inflation is going to go through the roof. All right, and as somebody who actually sat through the inflation period in the 70s, and had two Chancellors of the Exchequer as personal clients, they actually quite welcomed inflation at the time.
How high do you think it could go then, John?
Well, we've been told this week, haven't we? 18 point something. RPI is 12.1, not the headline figures, and we've got the pensions minister telling us that the unfunded pensions for civil servants are unsupportable. So once everything's in the protection fund, who's going to pay the protection fund for going forward? It's a taunting, isn't it?
Oh, let's not go there today, please. Let's not do that. Yeah.
Well, it's something.
Yeah, I know, but I know what you mean. I know what you mean. Yeah. Yeah. No. I
was only an advisor anyway, so sorry about it.
No, I appreciate that. Appreciate that. Professor Bromwich, do you want to defend professors who come up with all these statistics and predictions? Do you want to unmute? There we go.
No. Anybody who's foolish enough to believe they can work out the future deserves all they get. And therefore, it is a bit of a problem for pensions and seeing how they last. But I mean, economists are doing something very difficult, as we all know, and they get it wrong and so on. But if you look at pensions, I mean, if you look at DB pensions, the great majority of things are out of any trustee's control, and you can lock some things down. But basically, the whole thing is enormously fragile. If you looked at USS, their assets went up enormously, and now they're falling again. But luckily, it's offset by yields changing. All I'm saying is the DB world is fighting to try and protect itself against things which are not really able to be entirely protected. So, for example, you can't, I think, expect to protect yourself against 18% inflation unless you've got some ideas that I don't have. The other thing I'm really concerned about is all the things we've been talking about today, which I have to say I thought was really very good, very interesting. And I do think actually, going back to the 70s and seeing what happened might be a very worthwhile thing to do. Because although I lived through that, I actually can't remember where why the inflation disappeared. I thought some good reasons were given. But if you think about it, all the things that we've talked about today affect DC pensions. And there's nobody in DC area who's protecting DC pensions. You get what you get, given what you've invested and so on and where you've put it. I think that's going to be a major crisis as well. So the only thing I can really leave you with is a thought that it's not just DB pensions that have got problems, it's also DC ones. And DC ones are much more important in some sense because they affect far more people. I don't know whether that's helpful or not. I mean, the problem with titles like the one we had today is it allows one to speculate, but not necessarily to take any action. Thank you.
Okay, Anthony, what do you think about that? And we do want we do want to see some action. Trustees, advisors can't just sit on their hands, can they?
Well, clearly we're in an unfamiliar set of economic circumstances globally, nationally, at an industry, and it's got to cause people to stop and think. It's perhaps been too easy, for the last 10, 12 years to just assume that next year will be a continuation of last year, and there's various sort of shocks we've seen explicitly through the likes of COVID, the concept of war, and and that has at least spiked some things. But I think I'm more worried about sort of invidious change and things like, as I said, the quiet quitting, as it's a lot harder to pick that up. So the professor was right. I think that we should try and see if there are any obvious lessons of history, so that we don't repeat them. Although history tells us that's usually the one lesson that we don't learn. But there are a number of things that would argue it is different now, and this needs perhaps a new dynamism. It needs a recalibration. It's understanding that we're working with the right tools, and I do come back to this sort of data point that we've got a lot of data, so we've got a lot of giga, but I think it's probably more a little gibbo, as in gigo, or as in garbage in and garbage out. And I'd like to see sort of better quality data to facilitate decision making, but better understanding, greater clarity. And we're trying to sort of seek perfection in so many areas, and that sort of tends to sort of lead to delay. The world has not been perfect. Life is unfair. Nothing's changed. My mother telling me that when I was a lot younger, but it shouldn't stop us from doing something.
So if you're an independent investment consultant advising a board of trustees, what would you be saying today? What should they be saying? Or there's not a magic wand. We keep talking about Harry Potter and his magic wand, but there isn't a magic wand. But if you had that responsibility, what would you be telling them to advise?
So I would be looking for somebody who was creditworthy enough to offer me some sort of a funding level hedge, so I could lock out my position today. And I would largely now be investing in physical assets, and looking there for moving away from the sort of volatility of stock markets, looking at sort of long-term private market assets, looking at real estate, in and possibly in other economies. We're trying to work out where the currency, but because if sterling is undermined and dollar is undermined, what are going to be the reserve currencies going forwards?
Yeah, that's good. That's good. Andrew Young, do you want to sort of make a point about the PPF plus? Do you want to say something there, Andrew? Ooh. Okay. What about Gareth? Gareth, do you want to make your point regarding the practical problems for pension recipients? Do you want to make a point there, Gareth?
Yeah, I mean, you have to recognise that I know nothing about how pensions work, so I sort of sit here trying desperately to learn some things from what fascinating, but to me often a little bit sort of hard to grasp stuff. So I'm always focused on the end. I guess the problem of the industry, no doubt, are real, but the problems of the pensioners are even more kind of real and even more immediate, perhaps. And whatever kind of pension we're talking about, I guess, other than DC, whether it be kind of state pension or state benefits or DB pensions, isn't the pensioner always going to be lagging, they're behind. I mean, any pension increase is rated to something that caused the real impact on the value of their money months or even kind of a year or more ago. And, you know, is there any kind of scope for the industry to recognize kind of an immediate crisis and respond to that?
What do you think, Antony?
It's always been one of the oddest things that you pay somebody their pension, the largest pension, the day before you put them in the ground. So the whole shaping of pension benefits is probably wrong and needs greater flexibilities. I mean, pensioners have one protection in so much as you can't actually reduce them. So if you go into a recessionary environment, pensions are floored at zero. So they have scope to get a real pickup then. But this is often, you know, one of the challenges of looking at various metrics of inflation. It's not necessarily what people spend money on. And, you know, the classic used in the basket of goods is always the sort of the television. You know, you could sort of say, well, fine, you know, I've got a 42-inch television, which 5 years on, the cost of that 42-inch television has come down. Trouble is, that's not what you normally replace your 42-inch television with. You replace it with an 85-inch television. So substitution effects in inflation is very difficult to try and track, and you hope that sort of technology mitigates that. But yeah, Gareth's right. You know, for the pensioners who have, you know, less control are simply sort of income takers. They can't control what they're going to do going forwards, and yet are faced with an increasing longevity, an increased cost burden, and no obvious way of sourcing replacement income.
Yeah, no, I agree. Barbara Ann Thompson, you're arguing that trustees and advisors are trying to do something. What are they trying to do, Barbara Ann?
As an advisor, I suppose, get vested interest in the comment. I think trustees and advisors are looking to protect. They are looking to make changes. They are looking to improve data. They are all of these things that have been mentioned. But at the end of the day, I think there's a lot of constraints on what they can do. Partly because of cost. Someone has to pay for it, and invariably that is the employer. So you get pushback from them on what they want you to do and what they'll pay for you to do, but also increased regulation. There's been a lot of really good points made today, but again, TPR are telling trustees they need to reduce risk, they need to have a look at maturity, this, that, and the other. The point you made about looking at alternative assets, it's all great, but we've got to think about liquidity. How do we actually pay those pensions? So there's just lots of, I think if you speak to trustees, advisors, they would love to be able to make some huge changes to what we're doing and really simplify things and really look at the problems, but there's just so many constraints. I think it's just something that we need to think of as well. And who I'd love to know what my crystal ball is saying about next year, but it's gone a bit cloudy. So not at the moment, but who knows?
Yeah, is there a Barnett Waddingham house view at the moment then on all this? Because this is, you know, I mean, brilliant presentation, Antony. But this, you know, if I'm a sponsor, and a trustee, I mean, this is a bit of a storm. What's the house view of Barnett Waddingham at the moment, Ben?
So the one thing we don't have is house view. That's part of our independence.
Okay.
It's sitting on the fence, but we all have our own thoughts, and I think it's very individual.
Okay.
Each client, each employer, each scheme is very different, and I think that's part of the issue as well. Is everyone is different. Everyone has different aspects, different challenges, and so one solution won't fit all. And it's just something that I think we're all going to have to get our heads down and together and sort out over the coming months, years, how long ever this lasts.
Yeah, I agree.
That was a typical actuarial answer.
Thank you for that answer. That's very good. Yeah, it's very good. Henry Tapper, you have been silent for nearly an hour, and I can't believe it. Surely the great Henry Tapper must have a view on what's going on. Come on, Henry, you can unmute. No, maybe not. We can't hear you, Henry. So that's, yeah. No, can't hear you. There we go. I don't know. We can't hear you. There we go. Listen, we haven't heard from Henry Tapper in a whole hour, so I'm really pleased about that. To a point.
I can now talk. I will
there we go.
I've got very little to say other than thank you, Anthony, for your comments. Sometimes you just have to listen and learn from people who know a lot more and have got a different perspective from yourself.
Absolutely.
I don't have any of those thoughts that Anthony has in his head in my head. So it's great that there's been some thought transference, and hopefully I'll be able to think about these things in a new way. And I really don't have anything to add because, frankly, this is the area where I'm learning.
And that's what it's all about. That's what it's all about. And Anthony, that was a very thorough presentation. So really, really good. So a big thanks on Henry, our chairman, and big thanks from me. Professor Bromwich has got his hand up. Yes, my Professor Bromwich. If you could unmute Professor Bromwich, that'd be great.
Delay things, but one of the things that's come out of today is an enormous focus on tomorrow rather than 30 or 40 years time. I'm sort of new to pensions, but one of the things I was always told about pensions was that they live long enough so that any cock-ups at the beginning can be sorted out over their life. And I have a feeling that just at the moment, there's enormous fixation on tomorrow. And perhaps we should try to smooth things a bit over the longer run. That's just a thought.
Okay. Anthony, closing remark, and then we'll wrap things up. So, Anthony, what do you think?
Well, thank you, Steve, for the opportunity to let other people into the ramblings of my mind. And if Henry wants to consider it as learning, then I'll take that as a great compliment. But hopefully, what it has done today is stimulated a debate, has got people thinking that one, to maybe challenge what they're being told in the coming months, to prompt a few questions and say, have you thought about this? But rather than sort of just worry about, how much we refine and make things pretty, maybe we just make sure that we make things right. And, that is not going to be a quick fix. Yeah. But maybe the industry does need just a complete reset as to what its priorities are and how it is going to manage the runoff as an industry as a whole.
Yep, I totally agree. And one big takeaway from today is do something. That's a great end slide, and there'll be a lot of trustee meetings and advisory meetings in the next 2 or 3 months. September, October, November are very busy months, as we all know. Do something. I don't think you can, if you're not going forwards, you're going backwards. Isn't that an expression, Anthony, maybe? So, do something, but what a brilliant presentation, honestly. I think everybody learned something there, and really, really good. So really appreciate your input. That was fantastic. Next week, we just briefly discussed annuities, but it's going to be annuities. And I'm calling this Annuities Are Pants 2, because we had an Annuities Are Pants 1 earlier this year. But actually, are they now in vogue? So we're going to be having a discussion about annuities and what that means for consumers as well. So please join us on then. If you are not a member of Playpen, please join. If you are a member of Playpen, please invite others to join on the Invite Friends tab. And as usual, let's pray for peace in the East. So, Anthony, thank you very, very much indeed for your time today. That was absolutely fantastic. If anybody would like a copy, just email me or direct message me in Playpen, and we can get a copy if Anthony's happy to release that. Yep. And really, really appreciate your input. It's really, really good. And have a safe end of the rest of the day. And we'll speak next week at the next event. And thanks everybody for joining. Really appreciate your time.
Oh, thank you.
All right, and we'll put the video up on the website today or tomorrow. So there we go. Thanks, Anthony. Really good. Really appreciate that. Thanks a lot.